Good morning and welcome to today's first webinar. My name is Danny and I'm with the learning team with Cherry Beckert. I want to go over a few quick housekeeping items before we get started today. For audio during today's webinar, you may listen through the phone or the computer speakers. You can choose your audio under the audio tab in the menu to the right of your screen. To earn CPE for today's webinar, please make sure you answer all the polling questions. Make sure you click the submit button to submit your answer. Instructors will try to remind you of this as each poll appears. We will be distributing CPE certificates via email in the coming weeks. The instructors and I will answer questions in a question and answer pod. We will try to answer them throughout the webinar. So that's all for the housekeeping announcements, and I will turn it over to Matthew.
Thank you so much, Danny, and welcome everyone this morning to our virtual 2020 not-for-profit seminar. We're glad to have everyone with you today. We've got a great lineup over today and next week as well on the 15th. Our first speaker, I'm really happy to have with us, formerly with Cherry Beckert, Melissa Galasso is now on her own and has founded and is the CEO of Galasso Learning Solutions, LLC. Melissa's got over 15 years in experience really breaking down technical accounting topics and making it easy for people to understand. She's great at what she does. She's a certified professional talent development. She's earned the Association for Talent Development Master Trainer designation, and she is on the Not-for-Profit Advisory Committee, the AICPA's Technical Issues Committee, and has various other roles in several organizations as well. 2020 Enterprising Woman of the Year Award recipient, and also she's been in the 40 Under 40 by the CPA Advisor, not just for 2017, but 2018 and 2019 as well, I think. So Melissa, glad to have you. Thank you for spending some time with us today and going over what's happening in the not-for-profit accounting world. I'm here to learn because I know that there's stuff in the pipeline that I'm not aware of. And I encourage everyone to check out Melissa's website, Galasso Learning Solutions, and consider her for any technical training needs that you may need. So welcome, and I will hand it over to you, Melissa. Thank you.
Thank you, Matthew, and thank you for having me back. It feels like being at home. Super excited to have all of you with us this morning. So I am going to give you an update on what's going on in the not-for-profit accounting world. And really, we're going to focus on a lot of the topics that we talked about at the September Not-for-Profit Advisory Committee meeting. Unfortunately, due to COVID, it was a virtual meeting, but we were able to have some really good discussions, and we actually used breakout sessions and lots of new technology options to be able to do some small group discussions and to really dive into some of these areas. And so I am excited to share them with you. We are going to start off with, no surprise, discussions of COVID accounting and reporting. Seems to be the gift that keeps on giving this year. We'll talk a little bit about it from an accounting perspective. I'll also mention some of the developments from an audit perspective just to keep you up to date there. And then the bulk of our conversation at that meeting was related to actually post-implementation review of ASU 2016-14. We were really trying to figure out what were some of the lessons learned, some of the things that we can take forward as we have some new standards coming down the pike and looking at that. We're going to talk about the most recent ASU in the nonprofit world, which is going to be related to gifts in kind or contributions of non-financial assets. And we'll talk a little bit about why we have the standard and what the FASB's intent was there. We're also going to take a brief look at some of the current projects that FASB is working on that will be impacting nonprofits. And then a really interesting area, we didn't get enough time really to dive into this at our meeting simply because we weren't in person, and obviously you have to have a little bit of a briefness when you come to the online meetings. And so we started the discussion here on some international issues, but there's some really cool things happening behind the scenes, and I'm going to share some of what Jeff has mentioned in this area. So super excited. But let's get started with COVID-19. So obviously we have some really interesting CARES Act funding that we have to be thinking about. And for not-for-profit entities, PPP funds have been really dominating the conversation. But we know that this is because we've seen some impact, right? So The Charities Aid Foundation of America did a little bit of a study on the impact, and they looked at 550 entities and found that 68% had a decrease in contributions, 63% due to travel restrictions were unable to have their normal contact with clients, donors, and recipients, 56% had issues with client relations, 49% had disruptions to staffing, no surprise there, and then 34% with increased costs. And I would assume that that's going to go up as people are trying to return to work, and just the cost associated with the cleaning and the maintenance elements have definitely been there. And so as a result, nonprofits were able to apply for these PPP loans. However, it's been a very interesting and somewhat bumpy road as we go through this. So PPP loans in substance are loans, right? Entities are signing promissory notes with an agreement to pay back the loan at a very low interest rate. However, the intent of the loan is obviously forgiveness. People wouldn't necessarily be applying for these loans if they didn't think that they were going to have the loan forgiven. And so as a result, there was a little bit of a conflict over what is the appropriate accounting treatment. Now, thankfully for not-for-profit entities, we have had government grant accounting for a long time. That's not the same for public entities or private entities or commercial entities. They have really no government assistance guidance in the standards. And so they have obviously struggled a little bit more with the appropriate accounting, simply because there's nothing on point within the codification for those types of entities. Not-for-profit entities have two real options here that they can work with in the accounting for PPP loans. So when we look at them, obviously 958-605, which is our revenue recognition, our grants and contracts, which was impacted by ASU 2018-08, is definitely one option that we can look at. And we can also treat it as debt, topic 470. And so when we were talking a little bit about PPP loans, one of the things that we did mention was this is actually an area where we have less frustration than everybody else. And so it's nice to know that every once in a while the accounting gods are in our favor, and we have actual on-point guidance. But when they issued ASU 2018-08, which updated the contribution guidance, one of the areas that was really interesting is that they continued the scope exception for transfers of assets from governments to business entities. And so as a result, we didn't really have on-point guidance for those commercial entities. And so we spent a lot of time focused on that. But for not-for-profit entities, we really have two choices. We can use the debt model, topic 470, so we would debit cash and we would credit a debt, right, a liability. And so that would be included in our debt calculations and our loan covenants and things of that nature. And then when it is released, so if it is forgiven, right, it would be a gain on extinguishment, so a slightly different impact than if you were to go to grant accounting. The other option for nonprofits would be to leverage the model of conditional contributions under 958-605. And this is really important because when they were discussing the delay of topic 606, so when we were delaying revenue recognition for grant or for exchange transactions, one of the things the board looked at is should they also delay the effective date of ASU 2018-08? And ultimately, the board decided not to delay the effective date of ASU 2018-08, despite the fact that they were delaying the revenue recognition for exchange transactions because of the importance that that standard has for accounting for these PPP loans. And so at this point in time, when they were making the decision, they felt that having on-point guidance that was helpful was really going to be, for them, a really important element. And so they decided not to delay the effective date of ASU 2018-08 and to continue down that path. And so the 958-605 model is a conditional contribution model. And so when we talk about a condition, right, a condition prevents recognition. And prior to ASU 2018-08, the definition of a condition was a future uncertain event. And so we would have, if you raised $100, then I'll match you $100. Well, we wouldn't be able to recognize that match until you actually had the $100 contribution. The problem was there was an exception to every rule, right? That's how GAAP works. And in that exception, it said if the probability of not achieving the item of achieving the condition was remote, then in that scenario, it was just unconditional. And that was really for things like if the sun comes up tomorrow, or if you give me an annual report, right? In those scenarios, it's going to happen. And so treating it as conditional didn't make a lot of sense. And so we allowed a probability assessment. ASU 2018-08 said, we're going to change the definition. We're no longer going to talk about a future uncertain event. And now we have this consideration of whether there is a barrier that needs to be overcome and either a right of return or right of release. So if you don't achieve the barrier, then you either have to give the money back if it was given to you up front, or you don't get the money, right? And so that's really the concept. But probably the biggest change in ASU 2018-08 is the theory behind it, which is no probability assessment. It doesn't matter if you're certain that you're going to achieve the barrier. That doesn't matter. It's still going to be conditional. And so that was a major change in behavior. And so when we look at PPP loans, we have to now, you can't say, oh, well, I'm sure I'm going to spend it on payroll and I'm sure I'm going to maintain my headcount. And so as a result, I'm going to recognize this revenue now. You actually have to go through and meet the barriers. And within ASU 2018-08, they give us 3 indicators of a barrier. So the first one is limited discretion by the recipient on the conduct of the activity. And when you think about this concept, really the focus there was on things like, is it subject to single audit? Now, PPP loans are not subject to uniform guidance. They're not subject to single audit. They were excluded. EIDL were in, but PPP was out. But in these scenarios, it's not telling you what to spend the money on. It's not giving you a purpose restriction or a time restriction. It's telling you how to spend the money. The one that's really going to impact PPP loans is a concept of measurable performance-related barrier or other measurable barrier. And so the PPP loan said they will only forgive the loan if you use it for the appropriate items, right? So the payroll protection program says that you have to actually spend it on payroll or other approved items like rent and mortgages, et cetera. And so if you don't meet the measurable performance element, then they're not going to forgive it. In addition, you have to look at your full-time equivalent and make sure that you're meeting those requirements as well. And so as a result, that would be one element. Where we're getting most of the discussion from PPP loans is really related to the third barrier, or I guess the third indicator, because it's actually not a barrier, it's an indicator, and that is whether the stipulation is related to the purpose of the agreement. And so when we were trying to look back at the reason why we had the probability assessment, excuse me, the probability assessment in the prior standard, it was to deal with things like if the sun comes up tomorrow, or if you give me an annual report. And so they looked at that and said, well, really, those are just not related to the purpose of the agreement. And so they said, if it's not related to the purpose, if it's administrative or trivial, then those items would not be considered barriers. And so you would have to make that evaluation. Now, where things started to get a little bit interesting is in the example that they use in the standard, it says if you are only filling out a report to show that you've met the actual barriers, then that would be deemed to be administrative. So there are some who argue that actually, filling out the form and asking for forgiveness is merely just demonstrating that you met the barriers. Other people believe that forgiveness is a barrier that has to be overcome. And the answer is, it's up to you. It's really an area that's not clear. FASB has not gone through and made explicit address of how this works. This actually is an AICPA technical Q&A. And so there was a lot of discussion about how we can make this a little bit easier for entities as we go through it. The other area that they focused on was obviously our HERF funds, which are for our higher ed funds. These are going to be split between benefits to the university itself, as well as benefits to the students who are obviously significantly impacted here. And in this scenario, these are not loans, and so 958-605 is the appropriate accounting. However, under this ruling, because there is limited discretion, we are going to still deem them to be conditional. Provider relief funds are really where a lot of the conversation has been lately. It seems to be a moving target. Every time we start to think we have an answer here, it definitely has been a change that's happened, right? They've actually gone back several times and amended what they had said. So the federal government has really struggled with the implementation here. And what's been really interesting is that you didn't even have to ask for this money. This money was just literally sent. And this is $50 million in 2 phases of funding. And so this can be definitely impacting a lot of entities. So what makes this one a little bit more interesting is a lot of times it does follow the conditional grant, but some of the funding is actually additional patient service revenue subject to 606. So you have to really evaluate the actual amounts that you're getting here. And so as a result, we've spent a lot of time just talking about some of the issues that are out there, some of the things that we need to consider in this area. Again, nonprofits were a little bit better off because we have conditional accounting, we have grant accounting. Our commercial entities, they do have more options. They have 4 accounting options for PPP loans because they can leverage IFRS, which we don't leverage for not-for-profit entities. And there's also a concept of a gain contingency for commercial entities, but those are not applicable to our nonprofits. So we have the CARES Act funding, but definitely has been an interesting one. So we're going to do our first polling question here. And the question is simply, how do you believe most not-for-profits will account for their PPP loans? Do you believe that they will treat it as debt, or do you believe they will treat it as a conditional contribution? Now, there are pros and cons to both options. Obviously, with the debt model, it's a pretty clean, whatever did you borrow, right, comes on, and then when it's forgiven, it comes off. In the conditional contribution model, once you've met the barrier, then you can start recognizing revenue. And if you assume that the barrier, application and forgiveness is not a barrier, you can actually recognize it earlier. And instead of it being a gain on extinguishment, it would actually be contribution revenue. And so a little bit of a difference on the P&L side as well. So entities are going to have to make a decision about what is the appropriate treatment. And what I think has been really interesting is that FASB has been very open that it's really up to the entity to decide what do they feel is most appropriate here. So it looks like about almost 90% of you have voted. So let's get in those remaining few votes so that we can take a look at the outcome here. All right. All right, let's wrap up that poll. All right, excellent. So as you can see here, they about 53% think the conditional contribution 958-605 would be the predominant method. However, 47% think it would be Topic 470, which is our debt model. So again, it really is up to the entity to make that decision. And obviously, I'm sure auditors would be happy to have conversations with you guys about what makes the most sense for your financials. All right, moving on to our post-implementation reviews here. When we think about this post-implementation review, ASU 2016-14 was a major change, right? So it had been a good number of years since we did this major update to the financial statements, and they definitely were going to want to understand, well, what was the impact? And so at the Not-for-Profit Advisory Committee meeting, we leveraged some technology and we broke up into different groups. And so every group had a board member, as well as some staff people, and then members of the NEC who provided some feedback on how it went. So just a little bit of a reminder about what happened in ASU 2016-14. If you've wiped that from your memory, we had the change in net asset classification. We went from 3 net asset classes to 2. So with donor restrictions and without donor restrictions, removing the concept of temp and perm differentiations. Now, again, we still have the information in the notes, but it's not a required classification for net assets on the statement of financial position. We also added those liquidity and availability disclosures, which were trying to provide information about the availability of funds for the future and the liquidity of the assets that we had. Functional expense allocation and functional expense presentation, requiring either a statement of functional expenses or having it in the notes, or again, using, you could leverage the statement of activities to provide both nature and function in one place. And so that was a change for some entities. Now, some nonprofits had already had that requirement, but for many that was going to be new. And some actually had already voluntarily provided it. Requirements for disclosure of board designations were added. Direct investment expenses, whether they were going to be internal or external, were going to be disclosed. And then we were no longer going to, when we do the cash flow, if we chose to do the direct method, we did not have to do the indirect method as well. And so that was one of the changes there. So we went through and we talked about, obviously, what was the impact, what was the lessons learned? And I was really fortunate. We had Christine Bodison in our group as our board member, and she asked some really interesting probing questions because the FASB wanted to understand, one, how long did it take? How much cost was there? But what were some of the things that we could say that went really well, or that perhaps did not go so well, that we could learn from? And she has a lot of great questions, and I really enjoyed her thought process, because in her opinion, if we can learn from past implementation, they can issue standards going forward that allow the same benefits. And so one of the big lessons learned was leave a lot of lead time. So one of the things that was commented over and over again is by having that long runway, some entities who early adopted allowed others to really leverage that. So by not making it effective the following year, but giving a long period before it was effective, we had our early adopters that we were able to go look at what they did, understand some of the various alternatives, and not just look at the examples in the actual standard. And so that was something that definitely, for a lot of entities, especially smaller entities, having the additional lead time, having someone go before them, having someone to look at is great. Very often for private companies, we tell them the same thing: let the public companies adopt it, and then let's look at what they did. Well, that doesn't always work for not-for-profit entities. And so having that long lead time really did have a big impact. And when you're going to make some major changes to financial statements, the longer you can give people and the more people who early adopt, that gives us that opportunity. So that was one of the big feedback that they got. The other thing that is, because there was so much hype about the standard, right? It was a major change. Everyone had heard about it. You couldn't, every not-for-profit committee, every not-for-profit conference, the FASB went on this huge speaking tour. Every audit firm was out there talking about it. We started early. So we saw when things get pushed to the end and we don't really think about it. And then we get to the implementation date, we're like, okay, what do we do? We didn't really find that with 2016-14. We found a lot of entities started early because there was so much conversation about it. And so education seemed to be a consistent theme. I know that, from my time at Terry Beckert, we did a lot of webinars as early as when it started. We even talked about it before it was issued, when it was an exposure draft, having conversations, spending time with our clients talking about it, right? Webinars, tools, outreach really did make a difference, because what we found was it was not something that was like stuck up on you and surprised you. Everyone had had a good chance to hear about it. So that long lead time mixed in with a lot of education really reduced some of the cost and complexity of the standard. Some of the best practices that we learned in doing this was to find the right level of aggregation versus disaggregation, right? And so some of the things that we said were like, be practical. Don't go into the weeds. Obviously, these areas require a little bit more judgment and flexibility. And so you want to be practical in your application, right? And we don't want to square peg in a round hole. We want to be thoughtful about how we tell that story. And so one of the things that they focused on was this concept of flexibility. And we're going to see this when we talk about the gift in kind ASU, very much having that consideration here. So they really wanted to think about how we can have judgment and allow people to tell their story. And so be practical about the adoption requirements. Think about it in a different way. Think about it from a risk perspective. Think about it from other perspectives. People said they brought in Treasury earlier on. They started bringing in other thoughts and trying to come up with the right method. We also found the examples being really helpful. The AICPA rolled out their example, which implemented it, but they don't just implement it, they gave us a before and after, so we could see the change that happened. The FASB obviously did a lot with the examples, especially in a lot of the trainings that they did and the webinars that they did. And so the upfront discussion and the education made this a little bit easier. And then because we kept talking about how important it was, we started to have more conversations with those charged with governance earlier. And so when we start having these conversations earlier, right, it's no surprise to anyone. We get to the board meeting, we're like, hey, we made these massive changes. They already knew they were coming. Other things that they found in here were the disclosure requirements, right? Very big change, moving towards a more principles-based approach. It was subjective. We were trying to figure out, how do we do this in an appropriate manner? How do we do this liquidity? How do we do this availability? And if you look at 10 different nonprofits, you're going to see 10 different ways of doing it. And that's the beauty of this. They allowed a lot of flexibility by doing a more principles-based approach. Instead of saying you have to take this number and then adjust this number and then adjust this number, they basically said, do your math, and then qualitatively explain, what were you thinking, right? What was it that you were making adjustments for? And so we started to see that element of it, and you're going to see that again when we talk about gifts in kind. And then involving others. We talked about those charged with governance, but other people who are going to be involved in this, talking to Treasury, talking to development, having them understand some of the implications on what this is going to look like. And a lot of people found that these disclosures are now helping them with trend information during COVID, right? So what were we doing trend-wise? What is the implication of COVID? We're able to really see that impact. So overall, one of the biggest feedback they got was that there didn't require significant system changes, right? So a lot of times when you're making massive change to the financial statements, you would expect to have to overhaul your ERP system or really make a lot of changes. From a systems perspective, we didn't see a ton, and we also didn't see a lot of changes to the chart of accounts. So while we were making some changes to the financials, the base from which they were built wasn't having a significant change. And ultimately, which I was very happy to hear, it was less expensive than expected. So most people said because they had such a hype and because they had all of these expectations, they had budgeted a lot more than they actually had to spend. And so that's always a good thing to have some cushion left over, especially from a nonprofit perspective and it being a G&A type of cost. This is a good option. And some people came back and said while they were doing this, they took the time to improve their internal controls in various areas so that they were as part of this process. So they felt like it was a really good implementation and they felt like the strength of the nonprofit really was shining through the financial statements. And so a very positive feedback on a standard that did make a big difference. So that's going to bring us to polling question number 2. Overall, how would you describe the effort on the adoption of ASU 2016-14? More than expected, about what was expected, or less than expected? And again, this is just your experience, right? So thinking about when you were going through this and implementing it, and obviously larger entities who adopted it earlier probably have a somewhat different perspective than those that adopted it later. And obviously size of staffing is going to come into play here. So obviously it's not a one size fits all. These are sort of generalizations that we came back with. But I think it's important to kind of get a feel from you guys. How did you interpret this from your perspective? So it looks like about 90% again of you have voted. So let's get those last couple in and then we'll take a look at what you thought. All right, beautiful. So let's wrap up that poll and close them out. And so not surprising, you guys were pretty consistent here. 78% of you said it was about what was expected from an effort perspective. 13% said it was more, however, and 9% said it was less. So excellent. Thank you guys so much for sharing. I always love to see what's going on in the real world. So we mentioned gifts in kind. This is the next standard that's going to be our big nonprofit standard. This came out in September. So at our meeting, we actually were waiting on it. And it's something that we had discussed quite a bit in our prior meeting in, I think it was supposed to be in March, but I think it ended up being in April due to COVID. We weren't exactly sure in March how that was going to play out. And so ASU 2020-07 is the presentation disclosures for not-for-profit entities for contributed non-financial assets. We tend to call these gifts in kind. So a little bit of the why, because I always think it's important to know why FASB is working on a particular issue. In this scenario, it was really a regulatory push. Some states in particular felt like there were some issues with how entities, nonprofits were reflecting their revenue, but also how some of commercial entities were reflecting the expense. And so from a regulatory perspective, we actually have a regulator who joins our NAC meeting, so it's always really interesting to listen to them. When you think about it, a gift in kind is a generation of revenue, and the goal behind the gift in kind is to allow the not-for-profit to not need to purchase something. So instead of giving them cash, we're either giving them something that they could use or potentially that they could sell to generate cash for their operations. And in some scenarios, some of the valuation was being called into question. And they wanted to have a little bit more insight into the valuation of these, because again, it is a fair value, it's a contribution, and it is a fair value technique. Now, when FASB looked at this, they wanted to provide more transparency, right? Because that's really what the goal of the regulatory agencies were. but they didn't want to change fair value measurement. And current GAAP did not provide any specific requirements for contributed non-financial assets or specific disclosure requirements for contributed non-financial assets. And so there was only some specialty guidance for contributed services. And when we think about this, as I mentioned, contributed non-financial assets extend our cash resources. So if we have them, we can either not have to purchase something, or we can sell them to generate cash. And the problem that we've seen consistently is in valuation, because if you think about it, fair value is a market concept, right? However, you're not necessarily a market participant. There may not even be a market for these items, and therefore it's a little bit more difficult to do. This is really aimed a lot at pharma in particular, so donations of pharmaceuticals, especially if they were expired or not available to be sold in the United States, valuing something that is in the United States that's not allowed to be sold in the United States makes valuation a little bit more challenging. And so the scope of this standard is contributions of non-financial assets. So these are going to be fixed assets, supplies. It excludes cash and stock, both of which are financial assets. So if you're giving a donation of Apple stock, that's not really what we're looking at here. We're looking at gifts of clothing, of food, of space. So fixed assets and supplies. And so in the new standard, it's a disclosure change, right? So very similar, we're changing the presentation and we're changing the disclosures about how we present gifts in kind. So the first thing that we're going to do to give more clarity into what's, a cash contribution versus a gift in kind is we're going to present these contributed non-financial assets separately. So on the statement of activities, it's going to be a separate line item, separate from our cash and other financial assets. So we can see exactly how much the nonprofit is receiving in these gifts in kind. In addition, this is where this principle-based concept really carries over. How do I disaggregate this? So we're going to disaggregate the amount of the contributed non-financial asset recognized within the statement of activities by category. However, FASB does not define these categories, because if I'm a university, what people are going to donate is going to look really different than if I'm a soup kitchen, or if I'm a K-12 school, it's going to look different than a hospital, right? So think about donations of PPE during the COVID, right? So when we look at this, we are going to disaggregate these non-financial assets by category, but we can figure out which categories make sense for us. And so we're going to look at the types of non-financial assets that we generally are gifted, and then we're going to have disclosures for each category that we identify as a nonprofit. So it's very it's judgmental, but it allows flexibility. And so when I was asked about my opinion on the standard, I like the flexibility, because I think if they had come up with these predetermined ones, that the disaggregation would not have been as meaningful as if the entity got to figure out what is the appropriate disaggregation. In addition, they require disclosures regarding qualitative, in words, information about whether the non-financial assets were either monetized, were they sold, or were they utilized during the reporting period? So again, depending on what our intent was for them, if it was utilized, we're going to describe what program or activity the assets were actually used in. And then if we have a policy, again, some entities might not, but if the not-for-profit does have a policy about monetizing versus utilizing, we would have to disclose that. Now, here's where they were making the regulators a little happy. So that I will tell you, not all regulators love the standard. They really were pushing for a change in this. I think they wanted to see a change in how we define fair value, but FASB wanted to really keep fair value consistent and just provide more insight into it. So really, it's a transparency concept. We're not going to change the rules for fair value, but we're going to provide you insight on how you got to that fair value. So you do have to describe a description of any donor-imposed restrictions associated with the contributed non-financial asset, and then a description of the valuation techniques and inputs used to arrive at fair value measurement in accordance with topic 820, which is fair value. And then the principal market or most advantageous market, going back to some of the discussion for pharmaceuticals that you can't sell here in the United States. How are you, what market are you using to measure them? Used to arrive at fair value measurement if it is a market in which the not-for-profit is prohibited by donor-imposed restrictions from selling or using the contributed non-financial assets. So what I love about the standard, because I think FASB has really caught on to this, is that very often if something's in a standard, it becomes gospel. And that becomes problematic because we don't really have a one-size-fits-all. So they actually provided the same disclosure two ways. The first one, they did it with more of a, you can kind of see here, they gave the various types. So again, these are the categories that they identified. And then they had the amounts. And then they did more of the narrative down here. So they recognized contributed non-financial assets within revenue, including, and then they kind of went through it. They have a policy to sell all contributed vehicles immediately upon receipt at auction or for salvage value. No vehicles received were restricted for use. All vehicles were sold. Then goes on to talk about the contributed food, and it talks about where it was used, natural disaster services, domestic community development, etc. They also did the exact same one, except now you'll see here that they did it all in a tabular format. So the same set of categories, but now they're showing the amount recognized, the program that it was used in, the donor restrictions, and the valuation techniques. So really trying to make sure that it's not, this is the only way to do it, giving that flexibility, allowing us to be a little bit more creative. So they did not change the measurement. They did not change the fair value. Did they not change 958-605? They're just providing insight into the methodology. So this is going to be applied retrospectively, and it's for annual periods beginning after June 15, 2021. So we have a little bit of time. However, early adoption is permitted. So really very similar to 2016-14. Give a little bit of a runway and then allow entities to early adopt so that we can leverage some more examples, right? So these might not be categories that work for all entities. So let's get some other versions out there so that smaller entities can really leverage that. So early adoption being a great alternative here. So that brings us to polling question number 3. And this one is related, do you currently report any gifts in kind for your entity? And your choices are yes, no, and I'm not sure. All right, is there a materiality limit for the not-for-profit? Okay, so that's a great question. So again, anytime we have GAAP, there is this premise of materiality. So all disclosures are based on the materiality concept. So the standard doesn't have like a threshold or anything like that, but all of GAAP is built on this concept of materiality, starting with the conceptual framework. That is a great question. All right, let's see. Yes. So in this scenario, the question was, are the gifts in kind shown in the statement of financial or statement of activities and details in the notes? Yes, you can. You would have the separate line item on the statement of activity and then the categories in the notes. All right. Perfect here. Do a loaned vehicle meet the recognition for contributed non-financial asset? Are you talking about a lease there in that question? All right, excellent. I'm not exactly sure the context of that, so if you want to shoot me an email, I'd be happy to take a look at your question. All right, so let's take a look at how the polling question is done. So again, the question here is, do you currently provide contributed report contributed non-financial assets? And it looks like most of us have voted, so let's take a look here. 66% of you do, 24% do not, and 10% are not sure. So excellent. All right, beautiful. And my email is on that last slide, so feel free to shoot me a quick email. Moving on to some current projects FASB is working on. Obviously, leases, big deal right now. Leases obviously was delayed by ASU 2020-05 for all not-for-profits. Back in 2019, they delayed it for nonprofits that did not have conduit debt, but they gave us an additional relief even for those nonprofits that had conduit debt in ASU 2020-05, in particular trying to help out our higher ed and our hospitals who were really impacted by COVID. They're continuing to try to provide some improvements in this area. They have a current exposure draft out there. So sales type leases that have substantial variable lease payment, the accounting does not work out well in this area. It actually leads to weird losses. And so they're trying to fix that one. That came out of a roundtable that they were looking at. Remeasurement of lease payments based on a reference index or rate. So they were intentional on trying to make things easier, but it ends up being harder for some entities who follow IFRS. And so in that scenario, they are going to give a little bit of a reprieve. And then reductions in the scope of the lease contract. So if there is a change, again, they're going to be focused on giving us a little bit of reprieve from the extant standard, and they're going to allow us a little bit more flexibility in that area as well. What I'm looking forward to is what they don't currently have on the standard setting, which is some feedback that they got from the public roundtable that they did. So FASB met with people who had actually implemented, whether they were preparers and users, and they talked to them about how did it go. And the incremental borrowing rate is still something that I think is going to be very difficult for entities who have significant volume of leases. And today you're supposed to use the rate that's implicit in the lease, but even Microsoft didn't know the rate implicit in their lease, and so they had to use an incremental borrowing rate. But your incremental borrowing rate is the rate that if you were to go to the bank and borrow money on a collateralized basis, typically same period of time, same amount of money, what would the bank charge you in interest? Well, the problem with that is you're going to end up with, if you have 15 different leases and they're for different periods of times and different amount of money, 15 different incremental borrowing rates. And on top of that, not everybody has a starting point to work with. If you don't have a lot of debt, you're not going to know. And you might be able to call your banker and say, okay, if I were to borrow this at this, but this is not the easiest process. And so there's been a lot of feedback that the private alternative that they offered to both private entities and to nonprofits was just a risk-free rate. But a risk-free rate is going to be very low, and the lower the rate, obviously the bigger the liability. And so it doesn't really reflect it because nobody is borrowing at a risk-free rate. And so as a result, they're going to take a look at that. Modification accounting, you've probably, if you've been looking at some of the impacts of COVID, a lot of entities were not able to go into the office. Buildings were closed during either work from home orders or stay at home orders. And as a result, we already have a lot of contracts that have to be addressed from this perspective, which is, if I'm not allowed to go and use my building, do I really want to pay rent? And the answer is typically no. And so there's two different things that we saw during COVID. Sometimes it was just forgiven, right? They said, okay, we were closed for 3 months, we're not going to charge you rent. Sometimes they said, okay, we were closed for 3 months, we're going to tack those 3 months onto the end of your existing leases. In both of those scenarios, you might end up with modification accounting, you might have to do all of this remeasurement, or you might have to then, if you're under 840, allocate the amounts that's going to be reduced over the remaining items. And people are like, well, that's really terrible accounting. And so the staff did put out a Q&A on lease concessions specifically for 840 and 842. However, we also need to continue to look at some of the difficulty in modification accounting. And so that's something that FASB is looking at. If you were impacted during COVID, please make sure you check out that lease concession staff Q&A, because it's not actually in the codification. It's a staff Q&A document and it's separate. So you want to make sure you're going to the FASB website for that one. Embedded leases, we know this is a big deal. We know that it takes a lot of cost and complexity, but what was really interesting is they said it was a lot of effort for not a lot of impact. And so a lot of people are asking whether there can be some more exceptions for private companies and not-for-profit entities, and then lease allocation. So these are some of the things that came up in the roundtable. Again, we don't have any standard setting yet, but we're hopeful to see some of that come forward. In terms of the conceptual framework, they are working on new definitions for the definition of an asset, the definition of a liability. And so there is an exposure draft that was out on elements, and they are updating some of the things that we know and love, but in particular, they are also making some pretty big changes in the nonprofit area. So definitely, if you haven't taken a look at that exposure draft, I would definitely recommend it. Some of it is interesting, like they've removed the word control from the definition of an asset, which I thought was interesting. Now, I actually asked about it at the meeting, and they, interestingly, the person who responded voted against the concept statement, so agreed with some of what my thoughts were. But I think it's going to be an interesting couple of years as they're trying to really update the framework. Balance sheet classification of debt is the gift that keeps on giving. I don't think that anyone's going to ever be happy with the outcome. They want to make it a more principles-based approach, but when they do that, some of the outcomes that come from it really don't reflect the economics. And so they have put it out for exposure draft twice. They get mixed feedback every time they do it. And so again, we're just going to have to wait and see there. And then goodwill. They just added a new project. Not-for-profits are included in this project. So if you are a nonprofit with goodwill, many entities in 2020 are going to have a triggering event, right? Thinking about March, where the Fed reduced their rates to near zero. We had the travel restrictions, stay-at-home orders. And so as a result, the cost of having to do that is going to be triggered by if there is recovery, right? This is a big issue. And so FASB has recently put out, they're actually any day now, it should have an exposure draft. They voted on it in November and they said mid-December. So we're getting pretty close to mid-December. We should have an exposure draft to potentially give us some reprieve from some of those potential goodwill impairment tasks that would be expected, even if you're already amortizing your goodwill. Because remember, both not-for-profit entities and for-profit entities that are private can now amortize their goodwill. But ASU 2014-02 as well as 2019-06 for not-for-profit entities require that if there's a triggering event, you would still have to consider whether there's goodwill impairment. And so they're going to give us a little bit of reprieve there. The last thing that we have that going in this scenario is going to be the international items. And so we have some issues that have been really brought out there. And so we have a new project that we're working on globally, and it's called IFR for NPO. And basically it's an initiative to come up with an international framework for financial reporting for not-for-profit organizations. And so today, there really isn't any standard. There's no international standards that's used. Many of the standards are for nonprofits, sort of afterthoughts. They have good, strong processes for commercial entities, but they really don't meet the needs of users for not-for-profit entities because they weren't top of mind when the standards were written. IFRS is actually silent to many not-for-profit issues, and so this leads to a lack of transparency. So they've created this new project, and they're bringing in users, they're bringing in preparers, they're bringing in auditors to try to come up with an international agreement on what nonprofit accounting should look like. And so it's been very interesting, and not surprisingly, Jeff from the FASB is going to serve on the technical advisory group. Now, Jeff is the liaison to the NAC. He's also the person on the staff who's responsible for private company as well as not-for-profit matters. And so he has been very involved in this. He's very excited about it. And there will be 18 countries that are involved in this. They have 18 country champions who are going to be involved. The US is one of them in trying to develop a global not-for-profit standard. And so instead of having these various gaps of different countries, and if you go to their website, which I do include in the back in the resources, one thing that's really important there is that there's just no consistency. If you look and compare multiple countries, there's no way you would be able to get the same information out of them. And so the goal of this project is to actually have general purpose financial statements. And so it would not be a special purpose framework or an ACBOA. It would be a general purpose framework that would focus on user needs and would be a full set of financial statements. So it's going to be a long period of time. They're expecting in January to put out a draft paper in this area. And so it's going to be a consultation paper, kind of give us some of the background on what they're working on. They expect to put out an exposure draft in the middle of 2023. And then the expectation is that we'll have a final standard in December of 2024. And so this is something I think is pretty exciting to have something that's a little bit more global, a little bit more comparable, and really address for some of, especially we're lucky in the United States, we do have a whole section in the COD for nonprofits, but that's not the case around the world. And very often we are very global in nature, and we might have affiliated entities that just don't have very good guidance here. And so we're going to have this option to really bring them some amazing options. So let's do our final polling question of the morning here, which is, in this scenario, would you be interested in adopting an IFR for NPO, so a more international global standard for nonprofit reporting? And your choices are yes, no, and I'm not sure. While you guys are answering that, let's see what we got in here. What was the delayed start date for leases? So sure. So if you are a nonprofit with conduit debt, it moved from calendar 19 to calendar 20 fiscal 21. If you do not have conduit debt, it moved from calendar 20 to calendar 22 fiscal 23. So we've got some time there. Why isn't the EU involved in that group? I'm not sure about the answer to that, but I'd be happy to ask Jeff. So if you shoot me an email, I'll ask Jeff and get you a response. All right, looks like all of you have voted, so let's close out that poll. And let's see, so 45% of you would not be, you kind of like our local gap. 45% of you, however, are not sure and would probably want some more information. All right, so that is it for our first session today. So I did provide you some resources if you're interested in learning more about the not-for-profit standard. That is the website that you can go to. I also provided the single audit applicability. So for some of these new HERF funds, PPP loans, some of the provider relief funds, what is the applicability? The AICPA has been keeping that up to date, and they actually just updated it again in November. So I would definitely recommend that you consult that pretty frequently to make sure that you're compliant as we go through. So with that, I want to thank you all for joining me, and I want to thank you, Sarah and Matthew, for having me this morning. I hope this was helpful in giving you an update about what's going on in the area of not-for-profit accounting. Have a very happy holidays.
Thank you, Melissa. We really appreciate it. And it was great having you back, even if it's no longer with the Cherry Becker title. Just as a reminder to everyone, you will need to exit out of this GoToWebinar, and you'll need to use the link in the agenda to go into the next session. So each session has a unique link. You got to get out of this one. If you stay in this one, it's going to end here. We're going to shut it off, and that just is allowing us to track attendance and get you CPE credit for each one of these sessions. So thank you, Melissa, and we'll see you all in about 10 minutes for the next session. Thank you.